Expectations grow for a December rate cut by the Fed as US disinflation continues. Australian wage growth is lower than expected, but that might not move the RBA, and the yen weakens further as the US dollar continues its surge. And the Aussie and Kiwi are weakening too. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ's head of Asia Research, Khoon continues our coverage of the effects of Donald Trump's election victory on global markets. Chinese authorities, for example, moved yesterday to support a weakening yuan, while foreign investment outflows in Asia have been picking up pace.
The market is still awaiting a full cabinet lineup that will serve in the second Trump administration. I think so far it looks like he has appointed some well-known China hawks, so that will continue to keep investors nervous.
But first, in 5 and 5 with ANZ, bets on a December rate cut by the Fed increased overnight as October price data showed disinflation continued in the US economy. As of 4 a.m. Sydney-Melbourne time, the S&P 500 was up 0.2%, while Treasury yields fell, the 2-year down more than 6 basis points, as the October CPI came in as expected at 0.2%. ANZ economist Bansi Madhavani says a positive sign within the data was that super core CPI at 0.3% halted an upward march over the last 3 months.
Our view is intact that the Fed will cut rates by 25 basis points in December before moving to a gradual easing cycle in 2025. In terms of market reaction, the CPI report led to markets repricing the odds of Fed easing in December. The odds of a 25 basis point rate cut now have moved up to around 70 to 80% right now versus 60% before.
The US dollar index hit a 2-year high overnight. At 4 a.m. Sydney-Melbourne time, it was up 0.3%. The Aussie dollar was trading down 0.65% at 64.92 US cents, while the Kiwi was down 0.57% at 58.90 US cents. Number 2. Australian wages grew slower than expected in the third quarter at 0.8% and 3.5% for the year. Remember, that's down from 4.1% in the second quarter. ANZ senior economist Catherine Birch says that's the lowest annual rate since late 2022.
Promisingly, we've seen that the 6-month annualised rate has steadied at 3.2%, and we're also seeing a broad-based slowdown in wage growth across award wages, enterprise bargaining agreements and individual arrangements. So this may give the RBA a bit more confidence that wages growth is returning towards a pace that is consistent with its inflation target band, notwithstanding the continued weakness we're seeing in productivity growth.
Number 3. Catherine says the lower than expected wage growth isn't likely to shift the Reserve Bank of Australia's thinking, though. It's partly due to ongoing labour market strength. ANZ Research is forecasting October jobs data out today to show another strong month of employment growth, and the unemployment rate holding at 4.1%.
Despite the Q3 wage data coming in a touch weaker than what looks like the RBA's expectations, we have seen that there's been a fair bit of stickiness in inflation. Disinflation has been quite slow on the trimmed mean measure, and we've also seen quite a bit of labour market resilience. So by itself, I don't think this would be enough to really shift the RBA's thinking, but the labour market data out today will be quite important.
Number 4. New Zealand's net migration fell below 45,000 in the year to September, continuing a decline from over 136,000 in the year to October. ANZ economist Henry Russell says outflows of New Zealanders to Australia keep hitting record highs. Over half the 80,000 Kiwis who left New Zealand in the past year went across to Australia.
There is very little threat to wages from this outflow. Probably more importantly is the other demand side impacts more broadly. Lower migration inflows obviously mean weaker population growth, and that's going to flow through to reduce demand pressures in the economy, and that's something that the Reserve Bank will be considering moving forward as it eases interest rates.
Number 5. The yen weakened through the key 155 mark to the US dollar overnight, sparking speculation authorities might intervene. A weak currency saw Japan's goods PPI rise more than expected at 0.2% in October. ANZ FX analyst Felix Ryan says that while the Bank of Japan wants to see inflation, it would rather this was from domestic services and not imported goods.
We have seen from a number of Bank of Japan officials, including Ueda previously this year, make some comments about weakness in the yen being potentially a bit of a threat to that policy normalisation process, and also part of the backdrop for some of the rate hikes or policy normalisation that we've seen previously already this year. So that weak yen, especially if we see dollar yen move higher from here, it already is in the mid 150s range at the moment, would definitely be something that the Bank of Japan and also the Ministry of Finance would be concerned about.
Felix Ryan there. Now, in our bonus deep dive interview, ANZ's head of Asia Research, Khoon analyses some of the ongoing effects of President-elect Donald Trump's election win on global markets, including yesterday in the Yuan fixing market.
Chinese authorities had been setting the fixing in line with market expectations, but today, for the first time, it set the fixing a lot stronger than expected. It came in at 7.1991 versus expectations of 7.2436. There's a strong signal from the Chinese authorities that they're starting to be uncomfortable about the pace of depreciation and are now seeking to try and stabilize the currency. So I anticipate that they'll seek to set the fixings roughly around the 7.20 level to send a strong signal to the market that they don't want the yuan to weaken much further from here.
What is driving that depreciation?
Firstly, there is the very strong US dollar on the back of Trump's victory in the presidential election, which in turn has driven US yields higher. Secondly, there are also concerns about the potential tariffs that a second Trump administration might put on next year. So that's also led to the yuan coming under specific pressure on the back of those concerns. And thirdly, the announcement by the Chinese authorities around the debt swap last Friday, I think disappointed the market. While they did signal 12 trillion yuan debt swap, markets were really hoping for more news about new fiscal stimulus measures.
This comes against the backdrop of outflows through October in terms of foreign portfolio investors withdrawing money from Asian markets. Just take us through the note you put out on that.
Yeah, so for the month of October, we saw a fairly large foreign investor outflows from Asia, excluding China. Most of the outflows were in the equity market, where foreign investors were net sellers totaling $13.6 billion US dollars. This was in anticipation in the betting markets that Trump might win the US presidential election. So that's the time when we started to see Trump trades getting put on. And part of the Trump trade was weakening in Asian currencies and Asian asset markets, which contributed to the foreign outflows.
Has it been region-wide?
Now, for the month of October, the majority of the outflows were actually from India in terms of the equity outflow. I think that is on the back of valuation concerns. The Indian equity market had rallied very strongly and had gotten to very expensive levels. And with the upcoming US elections, I think there was likely some profit taking. But since the election and so far in the month of November, we've seen further 5.7 billion of equity outflows. Now, this time around, the majority of the outflows were from the Taiwan and Korean equity markets. So I suspect that that is partly due to concerns about what a second Trump administration might mean for US trade policy and his threats of tariffs, which would be very detrimental to Asia, particularly the large export-dependent nations like Taiwan and Korea.
How much longer do you think this will go on for, and what is required in order to sort of stem the tide?
I expect the outflows to probably persist for a while, given that the market is still awaiting the full cabinet lineup that will serve in the second Trump administration. I think so far it looks like he has appointed some well-known China hawks, so that will continue to keep investors nervous about what kind of trade policies might be enacted in 2025. So I think that's going to keep investors somewhat nervous and cautious, which will lead to further near-term outflows. On top of that, there was a disappointment about the stimulus announcements by China so far, and that no doubt has also led to a weaker risk appetite in the region, contributing to outflows.
Couldn't go there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, November the 14th. Catch you tomorrow with what Australia's jobs figures today might mean for the RBA. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.